Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First up, Fed Governor Austin Goolsbee lays out the reasons for his dissenting vote. We'll have full Fed coverage ahead. Plus, David Ellison readies Paramount's next move for Warner Brothers. We'll speak to USA Network founder Kay Koplovitz about how all of this will play out in her view. And with college football playoffs just 1 week away, we'll dig into the booming business of name, image, likeness, and how Washington is looking to intervene. Let's take a look at the major averages right now. We are seeing a mixed picture again today. So right now, the Dow's up about 100 points. We continue to see this divergence between the Dow and the NASDAQ in particular. By the way, this increase in the Dow means we're on pace for another record close because it closed at a record yesterday. The S&P 500 also closed at a record yesterday, but the index is lower today by about a third. And the NASDAQ is the laggard of the three, not just today, but it has been, and it's off today by about 0.5%. The Russell 2000 also closed at a record yesterday, but it's little change to the downside today. And one more to check on is the S&P Equal Weight Index. Why am I showing you this one? Because we have been seeing a broadening in participation during this upswing here that has pushed the S&P 500 to new highs. So this is one of the ways that we measure that by looking to see if the equal weight is outperforming the S&P 500. Today it is. Another way we look at it is to look at the groups within the S&P 500 on a day when even though the overall index is slightly lower, it's lower because of the drag from tech. Other stuff is doing okay. Consumer discretionary, which has led the gain since the lows in November, materials, real estate. So we've got the other groups higher, but it's really just energy and tech, particularly tech, that are down a lot. And why is tech down so much? Well, really we can pin it largely on Broadcom, which came out with its earnings after the close yesterday and just did not meet the street's lofty expectations. Hock Tan, the CEO, came out with a backlog that disappointed some investors and at the same time sort of tried to play down some of the loftiest expectations for what's going on with AI. That said, the stock is still up a lot year to date, as we have seen people bet on Broadcom as one of the big winners of this whole AI situation. The other big thing that happened this week, of course, was the Fed. The Federal Reserve voting to lower interest rates this week by 0.25 percentage point, but it was hardly a rubber stamp move. 3 members dissented. Here with more on what that means for the path forward for the central bank is our Fed correspondent, Jennifer Schonberger. Hi, Jen.
Good morning, Julie. Chicago Fed President Austin Goolsbee and Kansas City Fed President Jeff Schmid both laying out their cases this morning for why they preferred not to cut rates this week. Goolsbee said he wanted to wait for more data on inflation before lowering rates further, though he added he remains optimistic that rates can come down by a, quote, significant amount over the next year. Goolsbee saying in a statement, quote, waiting to take this matter up in the new year would not have entailed much additional risk and would have come with the added benefit of updated economic data, which have been absent lately. Goolsbee has repeatedly said he is uneasy about heavily front-loading too many rate cuts and just assuming that inflation will be transitory. He said, given the last several years, getting more evidence first feels like the wiser choice. Meanwhile, Kansas City Fed's Schmid, who dissented for the second policy meeting in a row this week, said his outlook has not changed and that he believes inflation remains too high as the economy shows momentum and the job market, though cooling, remains in balance. Schmid saying, quote, right now I see an economy that's showing momentum and inflation that is too hot, suggesting that policy is not overly restrictive. Now, while Goolsbee and Schmid both dissented because they would have preferred to hold rates steady, on the flip side, we saw Fed Governor Stephen Miron dissent because he would have preferred to cut by a jumbo 50 basis points instead of 25 basis points. And separately this morning, Julie, we are hearing from Philadelphia Fed President Anna Paulson, who says she's a little bit more concerned about the job market than inflation and believes that inflation will come down over the next year. Back to you.
Jen, thanks so much. Appreciate it. Well, for more on the division within the Federal Reserve, I'm joined on set by John Hilsenrath, StoneX Senior Advisor and Yahoo Finance Contributor. And John, sometimes, because we talk to you a lot, sometimes I like to remind people why we talk to you. covered the Federal Reserve for a long time.
I think a lot of people are asking that question. You should have been there at Thanksgiving dinner.
Yeah. You covered the Fed for a long time at the Wall Street Journal. You wrote a book about Janet Yellen. You know a lot about the Fed. Just to like sort of level set for people.
Yeah, I appreciate that.
So this is why we talk to you about these things. And so you understand the dynamics of the Fed pretty well. So when you hear what Jen is talking about this division, which we haven't seen in 6 years' time, what does that tell you about kind of the path forward? I mean, it's, as we've been talking to people, it seems like their job is really tough right now.
Right, and like what I take for what Jennifer just very thoroughly reported is that they're in a complex situation, right? There's a bunch of different things going on. On the one hand, the economic situation is complicated. So on the one hand, we have inflation around a little under 3%. It's not clear if it's coming down or going up. We have a job market that's been weakening. You usually don't see those two things kind of moving in conflict like that. You have an economy that seems to be doing really well, driven by a tech boom. It's hard to know a couple of things. One is what's the right interest rate to set in this situation, but also like what problems can you solve with your interest rate decisions? I personally would argue, for instance, that a lot of the problems we're seeing in the job market aren't necessarily solvable by lowering an interest rate and boosting demand, because I mean a lot of it is being driven by companies trimming back their labor forces as they implement new technology. Like how much is more demand really going to spur that? It might actually just get us a tech bubble. So anyway, the economic environment is complicated, and then you have a changing political environment, an institution that has already been politicized, right? So the Fed, since the early 1990s, has been in Washington seen as an institution that you should just leave alone. The executive branch doesn't try to tell the Fed what to do. Of course, they influence the Fed by the people that they put on there to run the place. But we have a president who's been much more aggressive in trying to move the Fed, and there's a lot of moving parts in the next year with the new chairman and other factors. So yeah, you talk about watching the Fed. This is going to be a really interesting year to watch the Fed.
It will be really interesting. And the other thing that we have seen in terms of influence of the Fed is like you have fiscal policy that gets put in place, and then the Fed in some ways is seen as in some eras as like sort of correcting for that, right? Counterbalancing it, even though Jay Powell and his predecessors will say we don't comment on fiscal policy, but they have to deal with the after effects of that fiscal policy. And we have yet another administration that is adding stimulus in various ways.
Right.
And that means
that's another factor that's in flux, because like just now we're seeing, for instance, there are the ACA healthcare subsidies that are running off the books in now as we speak over the next month. And there's been this push in Washington by the Democrats and some Republicans to try to keep those things going, because it's going to cost people money. They're going to have less money in their pocket to pay for their health care coverage. And we just saw two measures fail in the Senate on that. And so as it relates to fiscal policy, are we going to be getting more fiscal policy or less? The president is talking about a rescue for farmers affected by tariffs, about sending people tariff dividend checks. So, my own instinct is in Washington going into an election year, you're going to get more fiscal policy and not less. So I think, and that's more stimulus, right? And the Fed has to respond to the economy that it gets. And I think it's going to be getting an economy with a lot of fiscal stimulus in 2026. And that's, I think, one reason why people are concerned about the inflation story still.
And another reason is we talked to a strategist earlier who pointed to, at least in the medium term, the inflationary aspects of the AI build out, right? We're seeing it on electricity already, but you can see it more broadly. So that's something also. In the longer term, there are obviously arguments to be made about the increase in productivity, that it could be disinflationary eventually, but it doesn't look like that's going to happen in the short term.
Well, I mean, I'm not sure if I agree with that, because, I mean, we are seeing companies, job growth has come to a halt, right, in the United States. And there's different reasons for that. There's been the immigration crackdown, labor supply is contracting. There is, I definitely see a trend of companies moving away from this mindset of hoarding labor and not hiring and not firing towards saying, all right, we're going to trim back our payrolls, right? And so that starts to, and if you look at the latest wage and benefit data, it looks like there's some downward pressure on wages and benefits. So maybe that goes the other way. I mean, there's also the possibility that all of the stimulus going into the economy is going to affect the values and prices of financial assets more than consumer goods, which starts a whole K economy question of like who's benefiting from this and who's getting hurt by it. So it's a complicated environment. So people must be asked, all right, so what's the bottom line, right? I mean, I think looking out to 2026, you have an economy that's got a lot of wind at its back from the AI boom, from fiscal policy, from interest rates that have been cut by almost 2 percentage points at the front end of the curve in the last year and 15 months. So, you know, I think we have an economy that's going to be growing pretty strong this year and asset prices that are probably going to be moving up pretty well. But then the negative effect of that is potentially more inflation that hurts the little guy. So a stock market booming and consumer price inflation, higher electricity costs, you just talked about, higher healthcare costs, potentially lagging effects of tariffs. So there's like more tension in the economy about, you know, people who have assets and capital and people who are just struggling to get by.
Right. And, you know, well, I could go down a whole rabbit hole there, but I want to ask you this. We're finally getting some delayed economic data next week, a jobs report on Tuesday, CPI on Thursday. How do we read those? I mean, I've had some economists say we're not going to get so-called clean data until next year, right? Because of the government shutdown and the disturbances that caused.
How do we read those? Very, very carefully and with some eye of skepticism. And Jay Powell just said this, right? So just quick review. For October and November, we're going to have reports on payroll growth, on employment growth, but we're not going to have unemployment data that's very reliable, because there was no survey of households that produces an unemployment report in October, and it was kind of limited in November. So the numbers we're going to get next week, you really have to look to the payroll data, are companies on net hiring or firing. And then you have the effect of the government shutdown, which could affect, you know, so early January we'll start getting a fuller read on where things are. But I think when you look at everything on net, there's very little out there that indicates this economy is slowing down. You know, and again, we're going into an election year. These guys in Washington have every reason to pull the levers and run it as hot as they can. And speaking about the Fed, I think we think that Kevin Hassett is going to be the next Fed chair. I think his instinct going into this job, his mandate, so to speak, is going to be to run the economy as hot as he possibly can without letting inflation get too far.
Good luck.
Well, it's going to be a tough challenge. It's going to be a really tough challenge, and that creates even more of this conflict inside the Fed. Like, how far are we prepared to go with this? So we're not going to have good inflation data, I don't think, until January.
Okay.
So that's why Austin Goolsbee said, why don't we just wait? Like, why do we have to do this again
What's
in
the
December?
rush? Yeah, makes sense.
It's a reasonable argument.
Yeah, I think so. John, thanks so much.
Thank
Good
you.
to see you. All your markets action coming up. Stay tuned. You're watching Market Catalysts. The Hustle Act, introduced in the Senate this week, is a bipartisan bill aimed at protecting college athletes' name, image, and likeness earnings. The bill would create tax-advantaged savings accounts for athletes who are now earning millions of dollars. It would also cap agent fees, require agent registration, and mandate financial literacy education. Name, image, and likeness, known as NIL, has rapidly expanded into a multi-billion-dollar business for college athletes in recent years. Joining us to discuss is Sally Fulp, who leads up NIL growth and development for Learfield, which is the largest sports media and technology company in college athletics. And he's here with me on set.
Thank you for having me.
Thanks for being here. I appreciate it. So, the Hustle Act, helping undergraduate students thrive with long-term earnings. You got to love the acronym bills here. You know, how do you think that the approach of this bill is the right way to try to correct some of because this NIL came out without many of those guardrails, sort of swept through college sports. Is this a way to sort of put some parameters around it that might be needed?
Well, I would say let's back up a little bit.
Sure.
Pre-NIL, pre-July 1 of 21, the traditional student athlete experience was come to our respective university, receive a world-class degree, win championships, character development. The fourth pillar to the student athlete experience now that is quickly evolving is commercial deal-making opportunities.
Right.
Commercial deal-making opportunities take time, right? So to activate with brand partners, student athletes have to post content, they have to do content media shoots, they have to make appearances. There's a recent study out that it's about 2.5 hours a week. Student athletes already are dealing with time scarcity. And so we have to properly support them in this new modern student athlete experience. And Learfield, we represent 140 universities around the country. We are the leading media technology content provider and data provider for college athletics. And so we now are interacting directly with the student athletes. We've done thousands of NIL deals with brand partners and student athletes. So we're learning a lot right now, but absolutely we do need to support the student athletes in this new experience.
Do you think that legislation is the right way to do it?
I don't know. I mean, I'm cautious on speculating on what legislation's right. I do think we need to get in the trenches on the student athletes and taking it from their perspective and making sure that we can accommodate them going to class, receiving degrees, winning championships, and preparing them for the next 20 to 30 years of their life when they're done with their eligibility as a student athlete.
Now, Sally, as we were talking off camera before we went on, I don't have a horse in this race because I don't follow college athletics closely.
You grew up as a Terp, though.
I did grow up as a Terp because my parents went to Maryland. That's correct. So I have some legacy knowledge of it.
That's the power of college athletics.
It is. I mean, people are very passionate about it. And on that front, one of our producers said this morning as we were talking about this, that NIL has ruined college athletics. Not my opinion.
Yeah.
But it's not it's not necessarily an uncommon opinion either, I don't think, that it has sort of made things uneven within college athletics. And I'm curious, I mean, obviously you have a vested interest in this,
Sure.
But I'm curious how you would react to that.
Well, I would just say, I think there's two different definitions of NIL, right? So you've got the perceived pay-for-play perspective of NIL that was primarily being facilitated through collectives up until 6 months ago when the House settlement passed, and schools can now pay up to $20.5 million to student athletes through that House settlement, through revenue sharing. And then you've got what we do, which is student athlete influencer marketing, right? And connecting student athletes with brands based on their likes and interests. And I think it's an awesome time for a student athlete because these are micro internship opportunities for these student athletes when you connect them with the right brands based on their likes and interests. And it does prepare them for the next 20 to 30 years of their lives if you do it right. And we're the facilitator and transactor of that. And so I think it can enrich the student athlete experience when it's done right.
But you're addressing the student themselves. You're not addressing sort of the bigger college athletic fandom experience, right? When you have, an LSU coach who is making a move because of NIL, or individual schools that feel they're disadvantaged because they don't have this infrastructure.
Sure.
What do you do about some of those structural challenges?
Yeah, there's definitely some challenging storylines out there, right, that we're all aware of. But I would say the interest in fandom of college athletics has never been hotter, right? And it's not just with football and men's basketball and baseball on the men's side, but women's sports has exploded. And you can call it the Caitlin Clark effect or the Oklahoma softball team, but the attendance and viewership of college sports across the board and the interest in the storylines and the stories that these student athletes now can voice. I mean, we were just talking before about Fernando Mendoza. What a great story that he has. And he's got partnerships with JLab Audio, and he's talking not just about the playlists that he likes on his headphones, but he's talking about multiple sclerosis and the fight against MS because his mother has the disease. And so when you're able to unlock these stories through authentic brand partnerships, that enriches the student athlete experience. It also provides increased interest in our sports, all our sports.
These are kids, right, who are
That's
getting
right.
this money.
18
and they're
to
getting
22-year-olds.
They're getting a ton of money. How do you help them not crash and burn. I mean, this is not unique to college athletics. It's, the people who are in professional leagues are frequently very young as well. But how do you help them manage that?
Sure. I was a product. I was a student athlete, right? And
what was your sport?
Wrestling. Yeah, so I was a wrestler. And when I graduated, my focus was really linear, just on wrestling, being in the mat room, and academics. And I had no internship experience, no business experience, no sense of my personal brand and value and internships and marketplace. And it was a rough 2.5 years in transitioning into the career workforce. What I would say that what we're discovering is with these student athletes now leaning into the business side and being very aware of their personal brand and the value of it, it is preparing them for life after college. And that can be just as valuable as receiving your degree, right? Or winning a championship, and the character development that comes along with being a student athlete. I think the brand literacy and the deal literacy that these student athletes are becoming accustomed to is...
What about the financial literacy, though?
Absolutely.
Is more to the point.
Absolutely. They have to be aware of all that. That's super important.
And there's even potential for more deals and more lucrative deals, because now there's a sponsor patches that could be allowed.
That's right.
On jerseys.
That's right.
So what would that mean for your business? Are you guys poised to get in there when that happens?
We are accountable to all our schools, our 140 schools that we represent, and making sure that we're pulling every revenue lever for the schools. I mean, if you think about it, especially with the Power Four, so they now have this $20.5 million expense where they are paying student athletes directly. Right. They have to fill that gap. And so what that means is, field logos, court logos, jersey patches. We just announced Accesso Biologics jersey patch deal with UNLV for $11 million. All of that is on the table. We've sold 35 court and field partnerships this past year. And when you do that, I mean, that puts next level attention to making sure these are very visible brands on campus real estate, that it aligns with the mission, values, and purpose of the university. And an example of Iowa Stadium and having John Deere's logo on that field is a perfect example of the alignment that can happen in unlocking new revenue opportunities for these universities. And we're the facilitator for all of that.
How does all of this affect the recruiting picture for, say, a larger school with a bigger war chest versus a smaller school?
It's a new arms race. It's a new arms race, especially at the Power Fours, but I would say no school is immune from making sure that they are in their recruiting and retention narrative, because student athletes can now hit the transfer portal, right, that commercial deal-making opportunities, if it's important to the student athlete, are part of the experience. And that's where we come in.
Right, but doesn't that disadvantage certain schools who don't have that, that expertise?
I would say that's where we're accountable to that, right? So we are the facilitator for the 140 schools that we represent. And I would also say that you're seeing larger markets with more commercial businesses and opportunities. I mean, the Austin market is going to have a unique advantage on commercial opportunities for their student athletes versus Pullman, Washington. And so that dynamic's going to have to play in and balance what these schools can offer their student athletes when it comes to real NIL or authentic NIL, which we facilitate.
Well, maybe I'll have my producer come and find you, the one who said
there you go. I'd love to talk to him about it. Absolutely.
Sally, thank you so much for being here. Appreciate it.
Thank you, Julie.
We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Welcome back to Yahoo Finance. I'm Brooke Tavama. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. Today we're watching shares of Citigroup, Alphabet, and FMCC. That's the Federal Home Loan Mortgage Corporation. First up, let's take a look at Citigroup, because JP Morgan upgraded the stock to overweight. The analyst said it expects Citi to benefit from a solid economy and strong markets-related activity, relatively more because of the concentration of revenues. Plus, it believes further transformation, including improving efficiency ratio, making progress on consent orders, reducing stranded costs, and chipping away at deferred tax assets, will all continue to improve Citi's profitability over time. The analyst called it a multi-year journey. Next up, we're watching shares of Alphabet, because TD Cowen raised its price target in stock to $350. That's up from $335.
So the reason behind the change? Well, get this, Google search estimates are up. The firm said it's seeing Gemini chatbot usage move higher following the launch of Gemini 3. That's on top of continued increases in search engagement driven by both AI mode and AI overviews. And get this, it's gaining share of OpenAI's ChatGPT users who are now saying that they're actually also using Gemini. The average 12-month price target on Google stock is about $340. And last up, we're watching the ticker symbol FMCC. That's once again the Federal Home Loan Mortgage Corporation. Wedbush double upgraded the stock from underperform to outperform. The analyst said the improved outlook is based upon the implications of a range of options that the Trump administration might take to recapitalize the mortgage giant. The analyst believes we could see some action from the administration near term. The stock is up more than 200% year to date. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Now time for some of today's trending tickers. We're watching Bitcoin, Rivian, and UBS. First up, let's take a look at Bitcoin. It is climbing today, rebounding after dipping below 90,000 earlier in the week as crypto traders weigh the Fed's rate cut on Wednesday. Bitcoin has been stuck in a range, really from 85,000 to 95,000. It's been stuck there for about a month following a major liquidation wave in October. And analysts say the market is testing the strength of its modest uptrend, with 88,000 flagged as a key support level. Next up is Rivian, the EV maker riding higher today after Needham sharply raised its price target to $23 from $14, citing the company's momentum in AI and autonomous driving. The firm says Rivian's deep vertical integration gives it an edge as vehicles become increasingly software defined, allowing faster iteration in driver interface and autonomy features. And Needham also points to strong liquidity with more cash and debt and growing enthusiasm for Rivian's upcoming R2 model ahead of its 2026 launch, but it is a little mysterious why the stock is up just that much. It's up 18% right now. It fell yesterday after saying it was developing its own in-house chips for its vehicles as part of some investor presentation. So interesting, it fell about 6% yesterday, but it is more than making up for those declines today. And finally, UBS. Those shares are rising to a 17-year high after a group of senior Swiss lawmakers proposed easing the tougher capital rules that the government wants to impose on the bank. The recommendations would allow UBS to use AT1 bonds rather than pure equity to meet capital requirements for its foreign subsidiaries. That would significantly lower its funding costs. And lawmakers also suggested letting UBS continue counting some software assets and tax credits toward those requirements. Investors see the proposal as a path towards a more favorable compromise, sending that stock higher. It was up higher by as much as 5% to its highest level since 2008. Right now, up a little less than 2%. All your markets action coming up. Stay tuned. You're watching Market Catalysts.
Welcome to the Trading Pit. I'm Jared Blickery, host of Stocks in Translation podcast, joined by Kenny Polcari, former New York Stock Exchange floor trader and host of Yahoo Finance's Trader Talk podcast. Look, today we're looking ahead to 2026, a midterm year that could bring some chaos, some confusion, and volatility before the dust finally settles. We're going to hit the big themes, the next phase of AI, quantum on the horizon, rising power demand, and what gridlock in Washington might mean for markets. We're going to keep it simple for you. Levels and triggers on the charts and a risk management framework that lets you sleep at night and trade another day. Because as we like to say, risk is the only thing you can control in this game. And let's get to some thinking about where we are in December and how we're going to kind of assess ourselves. So I know you like to focus on risk profiles. Tell us what that means.
So I think it's important for everybody to understand not only their own risk profile, but then the risk profile of their portfolio, what they put together. Because what you should understand is that every stock, every ETF has a risk score from 1 to 99, right? The same way your risk profile has a risk score from 1 to 99. 71 is S&P 500 market risk. So if you're at 71, that's your risk score. Above 71, you become more aggressive. Below 71, you become more conservative. But what people suddenly find out is that you have one risk score, but when you actually score your portfolio, it's a very different score than
concentration
than what you think it is. And as a matter of fact, it's funny. I had a conversation this morning with a potential client who's in his 70s. He's in his 70s, and
it was all NVIDIA.
And his basically, it's NVIDIA, it's Palantir, it's AMD. But his portfolio was way up in the high 80s. Meanwhile, the guy's 78, and he needs to be much more conservative.
Not a lot of dividends there.
And so not a lot of dividends at all. And in fact, he kept asking me, how do I get more dividends? Well, you got to get rid of some of those stocks. Not only because they're not dividend payers, but because they're way up on the risk scale. That's a portfolio that a 20 or 30-year-old should have had.
Well, unfortunately, most of those names are significantly up here to date.
That's right.
So let's talk about something called tax loss harvesting or just tax loss selling. And that's where you have an investment that might be underwater since you bought it, but you can use that potentially to offset some of your taxable gains. So talk to us about that strategy.
Right. And so that's a strategy really that wealth managers and that individuals should use as you move into the end of the year to take advantage of exactly that, right? Offset your losses against your gains. So this way then you can free up some money, you can use that benefit and then reallocate that money to wherever you think the next new sector or where you want to have more exposure. That's how you would do it through tax loss harvesting, and it's very, very effective. And actually, wealth managers do it all the time. That's part of kind of what we do, but individuals really need to understand that process as well.
Let us now dig into some of the themes that we're really interested in this year and maybe looking ahead to next year. So I'm going to navigate to a couple names. Let's start with IBM, and I'm going to put a max chart in. So this goes back to the 1960s, I believe. Right. It took a long time, but it broke out recently, and it's been hitting record highs. Is Blue back?
I think Blue is back. Look, to be fair, I own the name. The firm owns the name. So, right, I'm speaking from the point of view as an owner, right? Talking my book. But IBM is really a leader in that quantum computing space. I think you can't overlook someone like Big Blue. First of all, it's got history, right? It's a big mega cap name. It gives you lots of liquidity. It's also a very good dividend payer, but yet it still gives you exposure in that space.
Well, and you mentioned IonQ, so let's just go there too, and we can see, let's put a year-to-date on there. This is very volatile. It's only up 9%, up a lot more.
Yeah, so again, there's another one that I own, so a little bit I'm talking my book, but look at how volatile it's been, right? Very different from IBM. You have to make sure that you understand the percentage it is of your portfolio, why you bought it, make sure that the story remains the same as you go along on why you bought it. If it isn't, then you got to start to think of maybe unloading it. If the story remains the same, but you continue to have this volatility on pullbacks, you would add to the position.
All right, let's keep ticking these down here. IREN, I-R-E-N. I will show you the year-to-date here. Now, this is up 340%, and it was up quite a bit more.
Again, this is part of that AI story, right? There's going to be another one. It's very volatile. You can see it. Look at the chart, and it tells you have to be prepared for the rides. But if you take a longer view, I think this is going to be a name that's going to benefit.
Yeah, we've just rattled off a list of tickers. Here's some great ideas. How do you think about them as you add to your portfolio?
So here's how I do it, right? So if I own the stock already, I'm going to watch it. It's got to pull back for me. When I say something's on sale, I'm not talking 3 or 5 or 8%. It's got to be down 20%, or it's got to be testing the long-term trend line for me to add to that position. If it doesn't hit either one of those two metrics, I'm going to watch it and hold it. If we get down 20%, I start to lift my head up. I want to watch it on the chart to see where it lands on the long-term trend line. Then, if the story remains the same, but the stock's just under pressure for no other reason than the market's a little bit anxious, I would use that opportunity to buy more. Now, if it's a name that you don't own, you kind of want to go through the list of names that you like, look at their charts, identify positions where you think, here's a good entry point for me. I'm patient. I can wait for it and do it that way. Or you can always do it by just dipping your toes in. Buy a little bit if you like the name and then watch where it goes. If it comes in, you can add to it, bring your basis down. If it goes up, you can watch it, add to a little bit strategically.
Let's talk about some of your predictions for 2026. It is an election year, so guess what? That's midterms. Could see some volatility there. What do you think is going to happen?
I think we are going to see volatility and confusion the way that and chaos the way that you identified in the opening. Look, the whole House is up for bargains, right? So all 435 seats are up to be reelected. So that's going to cause some confusion. I think the expectation is that the Democrats are going to retake the House, but yet the Republicans are expected to maintain control of the Senate, and we have a Republican president, so therefore we're going to have gridlock. Guess what? The market actually loves gridlock. Why?
It's predictable.
That's right. It's predictable because nothing happens. You can't go too far left. You can't go too far right. Everything stays in the middle, and the market likes that. But remember, the market can function no matter what happens. It just wants to know what's happening. It's that lack of clarity in the first 9 months of the year that's going to cause that confusion until it becomes clearer on who the candidates are, who's the actual winner, what does that now mean, and then the market market can adjust. Look, you may not like the result, but the fact is the market can deal with it.
All right. Got to get your take on what the Fed is going to do. We don't quite know what the Fed is doing in December, but just big picture, next year, are we going to get more rate cuts?
So I'm first of all in the camp that we shouldn't have any rate cuts right now. So while I expect they're going to cut them in December, I'm in the camp that we could leave them right where they are. Now, I think the first half of the year, I think we see the Fed just remain patient and they want to wait to see how some of this chaos unfolds. Now, if the macro data starts to get really weak, if the labor market starts to honestly get really weak, then I would say, yes, the Fed will cut. But I don't see that yet. I don't see real weakness in the labor market. I see it ticking up a tiny bit, but not enough for me yet to demand that they continue to cut rates. Remember, we're already down 150 basis points from where we were, right? We're going to be back at, by after the after the December meeting, we're going to be in the 3.5, 375 range on the Fed funds rate. That's actually historically normal. That's not necessarily restrictive. It's not overly stimulative, which is why I think at that point, what's going to be interesting is what Jay Powell says at the meeting. It's not going to be about whether we get the cut or not. We're going to get the cut. It's going to be like anything. It's like the forward guidance.
That's right.
What's he saying about the next 6 months? What's he saying about the mindset of the Fed?
We got a minute or two to go. Let's bring it back to risk management. Any other thoughts that you would give to traders, investors heading into the new year?
No, I think, it's always about not being emotional, right? Is that trying to build a portfolio, understand your risks, build your risks, and then don't make emotional decisions. If the market backs off, and I fully expect that we're going to see the market back off. Remember, it's a midterm election year. Don't be surprised if we're down 10 or 15%. You should know that going in, so you should build your portfolio with that expectation that we're potentially going to see that. That should allow you to then not get emotional if that happens and to be able to take advantage of the pullback in the market.
Yes, and I think people should exercise patience for that because the market will come to you. And also, my recommendation, always have a written plan. Write down your thoughts while you're doing stuff because that's important.
That's right. And you can always go back and refer to them and kind of, it reminds yourself, if you have the written plan, right, it kind of settles you down if you go back and you look at it and you understand your reasoning in the middle of all this chaos.
And that's going to do it for this episode of Trading Pit. Hope you got your 2026 picks locked and loaded.
Coming up, the 3 financial moves all retirees should do before the year ends. We'll be right back. The Federal Reserve, of course, cut rates by a quarter point this week, and while the committee was divided, they stuck to their plans for at least one additional cut in 2026. Here with more on what that means for your money and what moves you should be making next is Rian Horgan, Silver founder and CEO, joining me now for this week's FA Corner, brought to you by Capital Group. Rian, thank you so much for being here. So we've got that this interest rate cut that just happened. Is there anything that people need to know and need to be doing with their portfolios as a result of that?
Well, I think, as we've seen rates being cut this year, we've obviously seen a really strong momentum in the stock market. So on a year-over-year basis, Julie, the stock market's up almost 18%. It does mean that, if you're thinking about, doing your required minimum distributions or anything like that, you have to be really careful on your calculations this year because your balances are looking quite different than what they were looking at the end of the year.
Yes, most definitely so. And, we're also, as you mentioned, getting to the end of the year. I know that you deal with retirees a lot or folks who are getting close to retirement. From that perspective, too, what are some things that people could be doing if they're in that point of life as we get to the end of the year?
Yeah, so I know we all want to celebrate the holidays, but as we get towards year end, there's a number of kind of deadlines that are looming. I think probably the one that most of us are familiar with is that final date, which is 12/31, to contribute to our 401ks. For most folks, that contribution is $23,500 as the limit. But if you're over the age of 50, you have that catch-up contribution, which goes up to $7,500. Julie, new this year is the super catch-up. And this is kind of one of the last legs of the Secure Act 2.0 that was passed in 2022. But parts of those rulings have come out over the years. So the super catch-up is now an additional $11,250 if you're between the age of 60 and 63. So if you turn 60 to 63 this year, you have that ability to make that additional contribution. So that's number one I'd be thinking about. Second thing I'd think about is if you're over the age of 70 and a half, thinking about qualified charitable contributions. A lot of folks are aware that they have to make their required minimum distributions out of their 401ks. But a really kind of nice tax play is to make that charitable contribution directly from your 401k or IRA. And kind of get a 2-for-1 there. And then the last thing is just to remember that deadline is 12/31 for required minimum distributions. Again, remember the amount that you pay is based on the last year's 12/31/2024 balances. So again, likely your portfolio is up over the year, so you should be running those calculations off of last year's balances.
I'm curious what the sentiment is like for your folks who are in or near retirement, given that the stock market's been pretty robust, but we've talked a lot about affordability issues, which certainly plague older Americans who are on a fixed income. So what are you hearing from them?
Yeah, and Julie, I think it's really a tale of two cities. I think on one hand, for folks that have money in the stock market, they have continued to see the benefits of being invested in their 401ks and seeing those balances grow. But I think that is not the majority of the retiree population. And this past 8 weeks, we've just completed Medicare enrollment season this past weekend. And I will tell you that the constant theme throughout Medicare enrollment was the pressure that folks are feeling on their day-to-day budgets. Healthcare costs continue to be on the rise. Doctors, taking themselves out of different Medicare plans. And I think for most retirees, the cost of healthcare in retirement is one of the biggest unknowns and the biggest pressures that they're facing on their day-to-day budgets.
Rian, let me ask you, calling a little bit of an audible here, given that pressure on healthcare costs, what's your stance on long-term care coverage? You can't buy it when you get to that age, or if you do, I guess it's really expensive. But for younger people who aren't maybe thinking about their health, how their health's going to be in retirement, is that something that they should be looking into?
It's a really good question, Julie. And I think, particularly when I talk to folks who are in their 50s and 60s, one of the comments they make to me is that their parents may still have a long-term care policy and the peace of mind that long-term care policy has given them. I think a lot of those policies, as we all know, were really mispriced. The carriers didn't anticipate both inflation or folks living as long. And so those policies have gotten a lot more expensive. But I think one of the things that a long-term care policy can provide you is, again, just this budget and planning. And I think for folks, knowing that they have funds set aside and that it's already planned for, I think really creates a lot of peace of mind. The question is, are you going to plan through an insurance policy, or do you have the discipline yourself to plan and really set aside funds to really kind of pay for those really expensive long-term care costs that many of us are going to have later on in life, particularly for women out there. What you see is the disproportionate amount of spending on long-term care as women, as we tend to outlive the male population.
Yes, it is an excellent point. Rian, thank you so much for your perspective here. Appreciate it. And that was FA Corner, brought to you by Capital Group. Coming up, we got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets, and we take a look at the major averages, which are now all in the red. We had seen a mixed picture earlier, but now things are taking a turn for the worse. Fridays tend to be, well, sometimes a little unusual, sometimes a little volatile here, but the NASDAQ has been leading declines consistently throughout the day. It's off by 1.5%. Now the S&P off by 1%. The Dow falling now by about 130 points, or about 0.25%. And we've had some late developments in the battle for Warner Brothers Discovery. Paramount Skydance is considering raising its takeover offer for Warner Brothers by as much as 10% as it plots its next move to break up Warner's merger agreement with Netflix. That's according to the New York Post. To help us map out the potential next steps in this takeover battle is a media industry veteran who's seen it all. I'm joined by Kay Koplovitz, USA Network founder and the first woman president of a cable network in television history. Kay, thank you so much.
You're welcome.
So let's look at this situation, which I believe you say, it feels like it's been going on forever already, but we might have still a long ways to go.
I think so. I don't think this will be over in a quick play here at all. I mean, I think there'll be lots of challenges if both parties want to stay in the hunt. So it could be a pretty long. I mean, I remember back in the early '90s when Barry Diller and Senator Redstone were fighting over Paramount, and it went on for quite a while. And Paramount was a minority shareholder in USA back then. I paid quite a bit of attention to it, but it seems it's a little bit similar to that if both companies are going to stay in the long hunt for it.
Is this a be careful what you wish for situation, or a sometimes the winner is the loser situation? I mean, sometimes these pursuits of media assets don't end up being accretive over the long term.
Well, that is true. I don't think that will be the case in either side here. I think that they're really the assets of Warner Brothers are very rich. Of course, Netflix has a priority position in the streaming wars, but look, it's not just streaming. The landscape is filled with many players. So it's not just their front position in the streaming wars that we're talking about. We're talking about the entire environment. I think that the big challenge is, they've got a corporate and a public stock. They're up against individuals who are not governed by that, and irrespective of the fact that Oracle stock has been dropping dramatically in the last couple of weeks. That isn't who's bidding here. It's Larry Ellison and his son David, along with their partners who are making the bid, and they're not restricted by that, really. I think they have the resources, and I think they're extremely competitive people. So, they may jump in and raise their bid. People are saying that they're going to do that. They're anticipating it, and I would anticipate it as well. What is going to be fired back at them? What is the board going to say? Is there going to be is the hostile bid going to go to the shareholders directly, as they say they're going to do? These are all factors. And no matter what happens with the two of them, who's to say there isn't going to be a third party there? And I hope the third party is not the president of the United States. Right. Which really shouldn't be weighing in. I don't believe in these types of bidding wars for companies, but no matter what, we're going to see more consolidation in the industry.
And I'm curious, as a veteran of cable in particular, what you think of the cable side of the assets of Warner Brothers, right? Both what happens to them and sort of how to monetize them properly at a time when it's sort of a deteriorating asset.
Mm-hmm. Well, there's no doubt tremendous changes have happened already in the marketplace, and cable networks, which were the disruptor back when I was running cable networks, USA and Sci-Fi and so forth. We were the disruptors in the industry, and I think probably the best outcome was the bundling of the services throughout the cable. The cable industry, was the secret sauce of the industry, really, to build out many different networks on a business model that really worked. People then felt, oh, that got expensive, and streaming came up, and Netflix has led all the way on that. It's now getting to be quite expensive because streaming networks were, $5, $6 a month. Now they're $20 a month a piece, or $39 a month. Now it's adding up for people a great deal. And I think that while these assets from Warner Brothers and Discovery are very valuable, they have a long life. And it's the library value and the ability to work with the franchises that are so strong. They've been the strongest in the industry for a long time, that and Disney. And it is interesting that Disney has just jumped in with ChatGPT and Sora and making their animation characters, which are extremely valuable to that company, available through an AI product. So it's really, mass changes are going on, and I don't think it's just Netflix and Paramount going to be in the mix here. I think there are many other companies that could make an offer for the cable networks, including CNN, or including those that are not CNN. And they still have value. Now, cable networks licensed a lot of the programming from others, from the studios and so forth. So they don't have the rights, longer term, to offer to either one of these companies. They revert to the original producers of them. So it's a massive change on the business of entertainment.
Right.
There's no question. And at the same time, really, live sports are what's driving a lot of the tech companies today, to bid for sports, because that's basically what people want to watch in real time.
What do you think all of this it means for the sort of creativity of Hollywood, or lack thereof, going forward when it comes to either streamed or filmed entertainment?
Well, the economic models for the creative community are changing. And of course, the big, fear among the creative community today is that they will be replaced by, AGI and all the tools that are coming to marketplace. The challenge for them is to figure out how to use them to their advantage. And there is a lot that can be done on that score as well. But yes, the writers, the producers, the people, the actors, are all concerned about being eliminated from the creative community in some way, maybe by bits and pieces, but ultimately, where will they stand? And I think that that's one of the biggest considerations in terms of what they believe. But then again, they are not in charge of this, acquisition. So I think potentially some of the bigger losers, but from my perspective, I think that you've got to learn to use these tools to your advantage and still be the creative center of creativity. It's going to change Hollywood and the payouts in Hollywood pretty dramatically, I think.
Yeah, most definitely. And I guess that Disney deal is just one sign of that, Kay. Thank you so much for being here. Really appreciate it.
You're welcome. Thank you.
Coming up, we'll bring you today's top trending tickers and get an update on the trading action from the NASDAQ. We'll be right back.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ. Let's get a quick check on the latest market action. We're about 2 hours into today's trading session, and now we're seeing all three major indices move into the red as we make our way to the middle of today to end this week. The Dow and S&P 500, after a close at record highs on Thursday afternoon, we're now seeing it move lower, down about 0.5% in intraday trading as we make our way into today. The S&P 500 also seeing similar downward momentum, down about 1.2%. After, once again, it also closed at record highs on Thursday afternoon as well. And the NASDAQ getting dragged lower after we got that report from Broadcom that the outlook disappointed the street. We'll get to more of that in just a second. But the NASDAQ down nearly 1.7% over the last 5 days, and today alone down about 1.7% as well. So definitely be keeping a close eye on that. Of course, we're keeping an eye on this, how we're going to end the year and if we'll see a Santa Claus rally. So definitely all eyes on that. But I do want to get to some trending tickers that I have my eye on. Broadcom moving lower today after the company said that it expects revenue, a minimum revenue, one way to look at about $73 billion in the next 6 quarters. That disappointed the street when it came to that outlook, and that's why we're seeing the stock move lower today. Also, taking a look at Tilray, that company is seeing quite the pop this morning after we did hear from President Trump that he's preparing, or we did not hear from President Trump, we heard reports that President Trump is preparing an executive order to loosen federal restrictions on marijuana. And so after this company has really struggled over the past few years even to maintain the momentum that we saw on the rise of weed stocks, that's not getting a nice pop today based upon this hope that President Trump will have that legislation. Also, Lululemon getting a new CEO. That company seeing a nice pop today, up about 10.5%. But this company year to date has really struggled to try to regain the momentum that it once had. It's down about 50%. And I do want to keep on that same sort of discretionary outlook because we are seeing a bit of rotation over the past 2 months as consumers sort of take on this risk off sentiment sentiment, or rather risk-off sentiment within the market. We are seeing investors move to healthcare. That has been outperforming the broader sectors over the past 2 months. We also have energy, financials, and also consumer discretionary also doing well. Down today about 0.1%, but once again, over the past 2 months, it's up about 5%. And also utilities over the past 2 months under some pressure, down about 5%. Taking a look at the NASDAQ, bit of a mixed picture there. Mostly companies. There we go, bit of a mixed picture. Mostly companies in the red, led lower once again by Broadcom, AMD, Palantir, some of those AI names playing off the back end of that Broadcom report. And the Dow, which was green to start the day, now seeing reverse momentum, led lower by Caterpillar, Amazon, Microsoft, and Nvidia today. So definitely lots of downward momentum. We are seeing some stocks, though, in the green this morning, including PMG and United Healthcare as well. Also, McDonald's seeing a nice pop, up about 1.7% today. Taking a step back, though, once again, all three major indices in the red. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout the session.
Now time for some more of today's trending tickers. We're watching Chipotle, Southwest Airlines, and Dell. First up is Chipotle. Shares are moving today after the company hit a major milestone, opening its 4,000th restaurant. This one in Manhattan, Kansas. The Little Apple, apparently. The company says it's now more than halfway toward its long-term goal of 7,000 North American locations. The boost today might be a welcome sight for Chipotle stock. It's down about 40% on the year. Unclear if that opening is exactly why the shares are higher. You do get some end-of-year rotation back into some of the year's losers. That could be a factor as well. Next up is Southwest Airlines. That stock is moving higher today. Austin City officials approving a new incentive deal that will help the carrier expand its footprint at Austin Bergstrom International Airport. The agreement pays Southwest $2,750 for each new Austin-based hire over the next 5 years, with the airline committing to adding 2,000 high-paying jobs averaging $180,000 a year. Texas Governor Greg Abbott and Austin Mayor Kirk Watson holding a press conference Friday to discuss the new deal with Southwest and its expected effect on the city. And finally, let's check in on Dell. Speaking of Austin, those shares are sliding today after a report revealed the company is raising computer prices for commercial clients because key parts are getting much more expensive amid the AI boom. According to Business Insider, Dell is increasing prices on many of its business laptops and desktops starting December 17th, in some cases by several $100s. Dell telling employees that demand for those components is surging, pushing costs sharply higher and making it harder to keep those prices down for customers. Coming up, we'll go live to the NASDAQ to speak with Wealthfront CEO ahead of its first trade as a public company. We'll be right back. Turning now to the Fed and the outlook for 2026, Yahoo Finance's Jennifer Schomburger spoke with Counselor to Treasury Scott Bessent's Joe Lavorgna about the Fed's upgraded growth forecast and what tariffs could mean for inflation early next year.
The Fed yesterday increased their outlook for the economy next year. They now see GDP growth of 2.3%. Fed Chair Powell said that he thinks that any price increases from tariffs could peak in the first quarter. They see inflation falling to 2.5% next year, but the unemployment rate is expected to hold at 4.4%. What's your reaction to that forecast for next year?
We're growing, Jennifer, at 3%. According to the widely followed Atlanta Fed, we were 3.6 last quarter. That follows growth of 3.8% in the second quarter. And when you take the federal side out, because the Secretary Bessent and President Trump want to get rid of wasteful government spending, we find the economy is doing even better. It grew about 4.5% in the second quarter. So we're generating very strong growth. And with the productivity trend we've seen and with tax policies, Trumponomics, if you will, means we should be getting much faster growth. 2.3 is not, I'm happy that I applaud the Feds for revising up their forecast, but those numbers are way too low. I mean, in President Trump's first term, growth was just under 3%. And before the pandemic, it was actually almost 3.5% right before the pandemic. Productivity is much stronger now. The president's policies, they're reinforced from the first go, and they added some extra real important factors like the expensing of factories, overlay that with abundant energy costs, which are pushing prices down to near 5-year lows. And the Trumpian economy should do much better, has been doing much better than 2.3%. Inflation will move lower, Jennifer, and then the unemployment rate will certainly drop. So there's a lot of good things happening, and I feel like there's the optimism is for real, and some of the economists, they are known as a dismal science, and maybe they're proving that a bit.
Well, Joe, just to build on that, I mean, you painted a very robust picture for 2026, and Treasury Secretary Bessent has said that we could see tax refunds of $1,000 to $2,000 per household next year because of the tax bill. That seems to me to stimulate quite a bit of demand, and the Fed has only penciled in one rate cut for next year. Does that seem right to you, where at the same time the president believes that rates should be a lot lower than where they are now, and he believes that the Fed should have cut by much more than they did yesterday?
Well, I mean, President Trump has got a very good instinctive knowledge of how the economy works. And we saw in the first administration, when the president was arguing for lower rates, that he was correct. We had productivity that was very strong in the first Trump term and very low and stable prices. We're getting even faster productivity now. Inflation rates are going to be trending significantly lower. So I totally understand the president's concerns and frustrations. In financial markets, when you look at things like the slope of the yield curve, what you see is that policy does appear to be restrictive. In other words, not even neutral, but it's actually holding the economy's potential ability back. And the president understands that. He operates in the real world, not the ivory tower world of academia, where many of the economists that work at the Fed perhaps occupy their time. And you could make a very compelling case for rates going down significantly further.
To your point, Joe, the Fed has cut 3 times since September, and you look at the yield on the 10-year Treasury, and it's sitting around 4.1%. Obviously, there's other forces in the markets that perhaps are counteracting what the Fed is doing, but are there any steps the Treasury plans to do to try to bring the yield on the 10-year Treasury down? Because as we know, that affects so many borrowing rates in this economy, particularly mortgage rates.
Well, let me say this, Jennifer, 2 things. Number one, you know, the difference between the Fed funds rate and the 10-year Treasury rate is still very narrow. And that's because the funds rate is high, even by Jay Powell's own admission. Rates aren't even at neutral. What the Treasury can do and what Secretary Bessent has done is put in place policies that will help with the president's vision and leadership of restoring fiscal sanity. I mean, no longer are we going to be running 6.5% budget deficits as a share of GDP in a full employment type economy, which was lunacy. And we're seeing right now significant improvement made in the back half of fiscal year 2025. And the good news is so far in fiscal year 26, which started in October, you've got double-digit gains in revenues year on year, and you've actually got continued declines in outlays. That is a recipe for economic health. And by the way, Jennifer, as you probably know, the U.S. bond market, as Secretary Bessent is rightfully proud of saying, has been the best performing market in the industrialized world. Rates have come down significantly from where they were. And as the administration continues to get the U.S. fiscal house in order, you're going to see those interest rates move lower. And once those interest rates move lower on less inflation, those mortgage rates are going to come down, and we're going to reverse everything that happened under the prior administration when inflation was running rampant and people couldn't buy things because rates were too high.
Switching gears, Joe, Treasury Secretary Bessent has put forth a new letter to make changes to the Financial Stability Oversight Council, a creature left over from the financial crisis. And part of the changes that he is proposing include unwinding some undue burdens, regulations on some of the banking system. What impact do you think that these changes are going to have on financial stability, the financial system, and our economy?
You mentioned creature, Jennifer, which I'm assuming was a pejorative term. The secretary, obviously spending a legendary career in the private sector and knowing how markets work, wants credit to flow freely, wants prudent, sound regulation, which is instrumental in maintaining the faith and confidence in the U.S. financial system, its depth of capital markets, which is unprecedented. But we want to make sure credit goes to the economy, that small businesses gain access to that credit. They're the backbone of growth. And therefore, the secretary is making these changes. They're prudent to get credit flowing more freely and make sure we're not doing things that don't make any sense and hold the economy back from its full potential. We want to get this economy continuing to improve for all everyday Americans and getting those wage rates up, getting growth accelerating, getting that capital spending that the president has helped push into the system, getting that to become as diffuse as possible. And you need the lending mechanism to help us on that score.
Turning now to the IPO market, Wealthfront, best known for its automated investing products and online platform that's attracted younger customers, raised $484 million in its IPO, which priced at the top of the marketed range. We're still awaiting of those shares to begin trading, the first trade there. But joining me for more in the meantime as we await that is the CEO of Wealthfront, David Fortunato. David, thanks so much for being here.
Thanks for having me.
So let's talk about the message you want to send here on your IPO day to investors. What do you want them to know about Wealthfront and that it's worth getting in here at whatever price you guys open up?
So what Wealthfront does is help folks early in their career, early in their wealth accumulation journey, folks that are 20, 30, early 40-year-olds, save and invest for the long term. We use passive investing strategies, globally diversified, low fee, low tax, and we help people build wealth. Our goal is really to compound with our clients for decades to come. We've done greater than 120% net revenue retention for each of the last 11 fiscal years as we've grown with our clients. This is just the start for us. We're looking to compound with our clients for decades more.
David, I'm just curious, it is a very crowded market, right? And you look at some of the leaders here in the types of things you're doing, the Vanguards, the TD Ameritrades and Schwabs of the world. How have you built up your client base given that competitive backdrop? And how do you expect to continue to not only attract but also retain your existing clients given that there are a lot of choices for them out there?
Sure, we offer a fundamentally different product. We're a tech company at heart. I was the CTO for 10 years. I built our trading infrastructure, data infrastructure, and a bunch of the products that we have today. We really try to deliver a great digital experience to client. We have the lowest costs to deliver our product to consumers, which means we share savings with clients. So clients get a better deal and better financial outcomes because we're charging them lower fees. The result of that is they have a lot of trust in what we do because they're going to be able to invest, save, and borrow from Wealthfront at better cost than they would get otherwise.
And David, when you look at your revenue, I know a lot of it is generated from cash management. In a falling rate environment, what does that outlook look like?
Sure, we have a hedged business model. When rates are high, we tend to grow more with cash management. When rates are lower, we tend to grow more with investment. That's exactly what we've seen in the second half of 24 rate cuts. When there were 100 basis points of rate cuts, we did some of our largest investing growth in the history of the company. Similarly, in the recent period, Q3 for us, we saw some rate cuts and investments have really picked up. Having this naturally hedged business model that can continue to grow throughout the market cycle has really been the core of what makes Wealthfront a great business.
And David, you guys, I believe, manage about $88 billion in assets, if I'm not mistaken, on platform. What is this sort of next phase for you guys? Is it offering different and more products? Is it trying to appeal to different and more kinds of customers? How are you thinking about that?
Yeah, so we're well over 90 billion in assets today. As we think about expanding, one of the big products that we've been working on is home lending. So our clients have sent billions of dollars in wires to escrow and title companies to help buy homes this year. We're thankful that we've been able to help our clients facilitate that. We'd like to help them even more by offering them a great digital experience on a home loan and lower rates than they would get from the existing industry because of our technology and our ability to automate things. We're confident that we'll be able to offer them a great rate and a great experience that ultimately will help them into a new home.
And how about the cohort that you guys are targeting? I think I know you've been targeting younger folks. Are you going to be moving up the age spectrum? Are you also going to be trying to move up the income spectrum in terms of maybe targeting higher net worth individuals?
So we have more than 11,000 clients on the platform that have more than $1 million on the platform. By starting with folks early, growing our trust with them and continuing to serve them across a wide range of products, we've been able to grow with clients, whether that's a startup founder who ultimately has success and brings assets to Wealthfront after a successful liquidity event, or someone who's incrementally saving month after month. We want to grow with our clients for the long term.
And David, I also want to ask you about the market backdrop, because obviously you're coming public at a time when, even if not today, but markets more generally are in the upswing, right? We saw the S&P 500, the Dow, the Russell 2000 close at records yesterday. So coming into what has been a wealth building environment for folks, what happens if that changes, right? What kind of modeling have you guys done, given that you're, a new IPO or relatively new company, if there is indeed a bigger market downturn?
We've actually been doing this for quite a while. We've seen 5 market corrections and 2 bear markets, including the event that happened right around the outbreak of COVID. Our clients are focused on long-term wealth building, and that means that they continue saving. If you think about what happens during a large downturn, for clients that aren't planning on using their money or withdrawing their money for a decade or more to come, it gives us an opportunity to continue growing and for folks to get their assets into the market at a little bit lower price. Because of a long time horizon that we and our clients take together, our clients see it as an opportunity to continue growing.
David, thanks so much for joining us. We'll keep an eye, see where that stock starts trading.
Thank you.
Thanks. Before we head to break, we want to get a check on the major averages, because we have seen them take more of a turn for the worse here. The NASDAQ continues to lead declines. It's down by nearly 2%. The S&P 500 now off by about 1.3%, and the Dow as well down about 0.2%. As you might guess from the fact that the NASDAQ's leading declines, tech stocks are the biggest drag here. We have, of course, been watching shares of Broadcom head lower, but it's not just Broadcom. I'm watching SanDisk, Western Digital, so anything to do with memory and storage is falling. Micron, which reports its earnings next week, is down today sharply as well. So we'll continue to watch this phenomenon here and watch this sell-off as it develops. In the meantime, much more coming up on Yahoo Finance.
What if I told you one of the best ways to judge today's bull market was invented before the Fed, before ETFs, and even before the S&P 500? Charles Dow, co-founder of the Wall Street Journal and the name behind the Dow Jones Averages, laid out a simple idea more than a century ago called Dow theory. And on today's Stocks in Translation, we're going to use it to show why this market still looks strong and how you can spot the cracks when they eventually show up. So Dow theory is basically this. It is a way of using the Dow Industrials and the Dow Transports to confirm whether the market's main trend is bullish or bearish, up or down. And here are some of the basic points. It was born from Charles Dow's editorials in the Wall Street Journal over a century ago. He never wrote a formal rule book, but later analysts pieced together about 250 of his columns and turned them into what we now call Dow theory. His big insight was to compare the averages of the companies that make the stuff, the industrials, with the companies that ship the stuff, the transports. When they're both going in the same direction, that is confirmation. And when one starts to diverge, that's a warning that a bigger change might be underway. And he was judging the market's big tides, not every little wave. He talked about primary trends that lasted years, secondary pullbacks that lasted months, and short-term noise that we mostly ignore. But regardless of the time frame, we use a very simple definition of trend: higher highs and higher lows for uptrends, and lower highs and lower lows for downtrends. And finally, Charles Dow would also look for volume confirmation in the averages. But because of the rise of electronic trading, ETFs, and other factors this century, we tend to see higher volume these days when indexes sell off. So it's probably best to ignore volume at the index level. With that in mind, let's look at some charts. And here I'm going to start out with a 5-year look of the Dow Industrials, that's in purple, and the Dow Transports, which is in light blue here. And what you'll notice is that the Dow Industrials are up quite a bit more, up about 62% versus 39 or 40% for the Dow Transports. You also might notice that the Dow Transports are just testing their record high from late 2024, about 1 year ago. But here's what I want you to notice. While the Dow Industrials largely were in an uptrend from the third quarter of 2022, during that same time frame, the Dow Transports were stuck in this sideways range. And they actually started to break out of it in late 2024. That's this little oops that we're looking at right there. But then they sunk back below. And I'm going to zoom in on this time frame with a 2-year chart, and I'm going to show you how this was a great warning sign. So here in purple, we still have the Dow, and so it made a record high here, came back, pulled back, and then it was testing its record high. When that happened, the Dow Transports could only get about halfway back up. Then they proceeded to sell off, test that little high again, and then they broke this low right here. And in fact, the Dow Transports and the Dow Industrials were both breaking their lows at about the same time. But you really had a pretty good warning in late January, early February that something was amiss in the markets and that we might have a downturn. Were we predicting that tremendous post-Liberation Day sell-off? Absolutely not, but we were expecting perhaps some kind of market decline. Finally, I want to show you what things have looked like since that April 8 bottom. That's when things really turned up. That was 171 trading days ago. And here you can see the transports have actually pulled ahead. They're up almost 40% here, and they really only broke out of this long trading range very recently. And so with this very long base, it reminds me of the slogan in technical analysis, the longer the base, the higher in space. And that's exactly what we're seeing right here. So both the Dow Industrials and the transports are making new 52-week highs right now. And that brings me to my summary conclusions here. How exactly do you use Dow theory yourself going forward? Now, since both indexes are currently in uptrends and making new 52-week or 1-year highs, we're only going to cover the bull case here, but the bear instructions are simply reversed. So first, are both averages in an uptrend, making higher highs and higher lows? Or is one starting to flatten out like we saw a year ago? Then when one flattens out, you might actually see it break its major low. This is a kind of change that leads to a bearish trend change. So that divergence can be an early warning sign like late 2024. And do both keep making new 52-week highs, or is one only pushing higher while the other tends to chop sideways? And finally, can you look at the breadth of participation inside those indexes? Are a lot of transport names and industrial names participating in the move, or is it just a handful of stocks pulling the averages higher? Price action always rules the day as only price pays, but low participation can be an early warning indicator of a potential trend change. So putting it all together, things are looking bullish as we wrap up a year full of surprises. And when the story changes, Dow theory won't call the exact top, but it will tell you when the big tide has started to turn. And tune into the Stocks in Translations podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
We want to bring you some breaking news that seems to be weighing on the major averages. It has to do with Oracle, and it has to do with a report out from Bloomberg that Oracle has pushed back completion dates for some of the data centers it is working on for OpenAI. It has pushed the completion dates back to 2028 from 2027, according to this report. Why? Because of labor and material shortages. Again, according to this report here. This all goes back to the questions around Oracle in particular and the viability of its future remaining performance obligations. This is something the company reported when it reported its earnings, came out with a big number for those RPOs, and its contract with OpenAI in particular is for $300 billion. Remember, we talked to Gil Luria this week from D.A. Davidson. He questioned whether OpenAI would be able to fulfill those obligations, would be able to fulfill that contract. So a lot of this hinges on OpenAI and Sam Altman's ability to continue to fundraise in order to pay for a lot of this, considering that its revenue to date has not kept up with its spending plans for the future. All of this is a bet on that. So All of that said, Oracle shares took a turn down after this story came out, and we saw the overall markets turn down as well. I've also seen some reports that Oracle's credit default swaps, which is basically a proxy for its ability to repay its debt, that those swaps have gone higher, meaning that they're seen as higher risk. So that's something to keep an eye on as well. We're going to continue to track all of this as we've been talking about the AI debate, whether it's too circular, whether it is a bubble. So this the latest development in all of that, and we'll be following it. In the meantime, much more ahead on Yahoo Finance. Waymo's self-driving cars, available in several cities across the U.S., have so far resulted in far fewer accidents than human drivers. That's according to data pulled from Waymo and Semaphore. But that may be changing, as a recent story from the Wall Street Journal, police reports and lots of viral videos on social media are showing self-driving cars taking more risks and driving more aggressively. My next guest says that might be necessary. Catherine Driggs Campbell, University of Illinois Urbana-Champaign Associate Director of the Center for Autonomy, is joining me now. Thank you so much for being here. Catherine, I gotta say, when you watch these videos, and there are a lot of them out there anecdotally, right? It looks alarming, right? You see Waymos involved in accidents, for example. You see Waymos driving through, in one case, a situation where there was a police stop and someone was being arrested, was on the ground. Why is, obviously we're in a process here of adapting these things, but what do you think is going on?
Yeah, so I think there's a few different, levels and sort of layers to this. So first off, people make these kinds of mistakes all the time. People get pulled over all the time. There's sort of a social reason why people, I think, are excited and interested in this and tend to highlight it more. Just someone getting pulled over by a police car is not going to go viral, but a Waymo will. So I think there's a little bit just of a perception kind of thing going on, where people are just trying to, figure out what's going on, and they're excited about it. So there's sort of a social layer. But to your point of, we have to go out and adapt these things. I think one of the big challenges for autonomous vehicles is the world is a really crazy place. It has to operate in really, really challenging environments. And unlike some other products that we typically interact with, you can't guarantee a perfect product by just testing in-house. You kind of have to go on the streets, you have to push limits, you kind of have to do that testing just to see, where it breaks down. Now, the hope is that you can do this while maintaining safety and still, providing whatever product that you actually want at the end of the day.
And Catherine, maybe this is an obvious question, but it seems like would all of this be safer if it was only autonomous cars on the road? If you took the humans out of the equation entirely and you just had robots driving, would that then sort of cut down all of this a lot?
Oh, totally. And there were actually very cool demonstrations of autonomous vehicles doing really amazing things back in the 90s, early 2000s, where it was a complete closed system, where it was just autonomous vehicles. So anything you can do to reduce the uncertainty will help autonomous vehicle performance. Unfortunately, humans are very unpredictable, highly uncertain. So they are one of the biggest challenges there.
And why do you think that these vehicles do need to be more assertive or aggressive, or whatever word you want to use, as they, make these adjustments on the road?
Yeah, that's a good question. So I think one of the big challenges is, as people interact more with these Waymo vehicles, they learn and understand what's going on internally. If you see Waymos driving a lot, you'll learn that they are passive. You learn that they are always trying to be as safe and sort of polite as possible, and that will be exploited. People, at the end of the day, are a little selfish. They don't want to let other people's merge, and there's, Waymos in particular. You don't want to sort of let them in. So if you are always passive, people will learn that, and people will, use that to their advantage. So by being more assertive, you allow that autonomous vehicle to, get to where it needs to be, which also helps traffic overall. So this isn't just purely, Waymo gets to do what it wants. It is also, making sure there's no backup traffic. You don't want to be stuck behind the passive the passive autonomous vehicle. So I think this is sort of an important thing for, overall improving the traffic and its performance.
Right, and to your point, it's sort of this balance between like having a good product that works and having safety, and where is that correct balance to have? I'm curious, as somebody who really studies this whole autonomy issue, and we've been talking about it for a while, and the question always comes up kind of where we are in that adoption curve. Because there aren't that many Waymos out there or Teslas out there that are driving themselves, they are very visible, to your point. They're going viral, but how far are we from them becoming routine?
That's a great question. I think one of the biggest challenges right now is, one, it is really hard to make sure that these systems are 100% safe. And as with these videos and things like that, there are still some kinks to be working out. So I think there's sort of a turning point in sort of perception and in a safety assessment that has to happen before there's complete trust and they can really go everywhere, or have at least more market penetration in specific places. I think there's also some challenges, and these systems work a lot better in known places. So they only operate in San Francisco and Phoenix and Austin and a few other places, but making sure they can actually get to other places, I think, is still a big hurdle.
Yes, we'll continue.
You don't see many in the snow that I'm looking out on outside.
Yeah, I mean, I guess the humans, the weather, cats, unfortunately, all of this stuff are the sort of wild cards when these things are driving around. Catherine, thank you so much. Really helpful to have an expert view on all of this.
Yeah, thanks for having me. Happy to chat.
Thanks. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming up.